Valens Research, Uniform Financial Analytics.
Shopify is super interesting. One, because when we look at the uniform returns versus as reported returns for Shopify, but far more importantly, when we look at the uniform versus as reported PE for Shopify. I mean, PE and EPS. When you look at Shopify, what you see is a company on an as reported basis that has had returns that have been consistently negative EPS almost every single year. In reality, over the last couple of years, Shopify's EPS has actually been positive, right? It hasn't been losing $1.10 a year. It's been making $1.10 a year. Importantly, though, also, if you were looking at the as reported metrics for Shopify, you'd think that for 2020, you were looking at a company that, was just bobbing along and was making its way to being profitable because of the fact that it was already a negative a negative EPS business. In reality, when we look at the uniform accounting metrics, we can realize that something way more important is happening for Shopify. Shopify was a profitable business. When we make all the adjustments to remove all the noise that we do using uniform accounting, right? This is something that you can see here. What we show you in the impact of adjustments page of the Valens Research app is we actually show you to explain to you what are the adjustments that we're making under uniform accounting. For Shopify, last year net income was negative. It was negative because of the fact that the company is compensating management in stock option expense. That's actually them turning management into owners. That's saving you cash as an investor, especially if you're a credit holder, but also as an equity holder. On top of that, they were investing massively in R&D. Those two adjustments alone basically explain why as reported earnings was negative when really earnings is actually robustly positive. We also do the same thing for the asset growth metric too, just for the asset base also, just for context. And when we look at that, what's so important, that means that they're going from a profitable business that's investing to now next year, they're actually going to potentially have negative earnings, negative returns. That's a big important inflection, especially for a company that's trading at a price to book metric of 45 times. They're trading at 45 times their asset base. The market is pricing this company for returns to basically go from 13% next year, 40% in the coming years. For a company that just had returns flip negative. Why? Because the market looks at Shopify and they say, yeah, Shopify is a negative return business, but look at how Shopify's returns are trending positive. Shopify's returns were negative 14%. Now they're negative 3%. And Shopify is growing massively. If they see an inflection, there's going to be a rocket ship. Well, actually, what's going on is Shopify has been a mature business the last 3 years, and returns have basically peaked at 15%. Even if they reverse this issue here, you're probably seeing a business that is a 15 to 20% ROA business. It's still probably going to be growing massively, right? It's growing basically 50 to 70% every single year for the last couple of years. Let's put in 60% asset growth. But let's be real. Let's expect that the top that they're going to get for ROA, even if they get past the fact that earnings went negative, is going negative in 2020 after being positive, even then, what would the stock be worth? Stock would be worth $310, right? It wouldn't be a $60 billion market cap business. It would be a basically $35 billion market cap business. Call it 36 to be exact. $36 billion market cap business. It would be a not $520 stock. It would be a $310 stock. This is a real issue. And the thing is, when you look at the as reported metrics, you see a startup that's inflecting and you get excited. You shouldn't be. You should see a company that was mature, and because of issues with operations, earnings are actually flipping negative. And even when they get positive again, we already know what the returns of this business are likely to be thanks to that. You know, it's worth saying there's another metric that we look at too, which is actually our quality to value scatter. And this also helps us understand what is a company's realistic return level. And so if we look at this, what we're basically looking at is, right, this scatter is what the returns are for companies, for a company and all of its peers. And this scatter is, right, what the price to book asset number is, for the company, right? So there's a very strong relationship between the returns a company generates and also the value that the company has relative to its asset base. So what I'm going to do here is, we're looking at the scatter at just Canadian companies. I'm actually going to look at the UK, US, and Canada in terms of showing the scatter, just to update it. And then after I do that, I'm also going to look at their universe, which is the internet services and infrastructure space. All right, let me just do that. Let me apply the filter. This way I can just get a more expanded universe of companies as opposed to just because they are a Canadian-based name. Otherwise, I get issues where I've got a very limited universe. I'm going to remove some of these outliers here, right? And then what I see, just move that, remove the negative return companies. And what I can start to see is there's actually a very strong relationship between the value a company trades at and the return the company generates. Right, I'm going to remove actually Shopify just to be able to see the scatter. But what we can start to see here is you notice, right, you've got clumps first and foremost, but things tend to trend up this way. But the really valuable thing for Shopify, right, when we come back to this idea of what the market is pricing in, which is for ROAs to get to 43% with massive growth versus what the company's done, is lo and behold, if I look, there is one company, TCX, that actually has returns that are well above those levels. Obviously, a VeriSign, but VeriSign is a completely unrelated business. If we actually look, what we can see is instead, what's incredibly powerful is, oh, I just realized why this is weird, because the fact that I had both car businesses and internet services businesses. So let me just actually redo this. So I remove all the car companies. We can see though is there's going to be a clump, right? There's going to be a clump that is right around an ROA that's between, right, 20%. And actually there are a couple that are up here, right, that are actually at 40 to 50%. So maybe what's interesting is what the market's looking at is they're actually looking at these companies and they're saying, hey, we think that this company can actually get, right, to the returns like Descartes, like what is this one? This one is CSU, like Constellation Software, and also like Jib, which is CGI. They can get, as opposed to being like OTEX, right, open text, and being like Kinaxis. So what the market's looking at is saying, hey, you're not like these firms, you're like these firms, and that's what the market's pricing in. But the question is, can the company actually get there? And that's where we get to where we're able to do a scenario. It's basically, if this company gets to best-in-class returns around 45%, it's fairly valued. If it gets to more normal returns like these peers, well, quite frankly, this company is looking to basically get cut in half. And that's the kind of scenario analysis that we can do using uniform accounting that you can't do using the as-reported distorting accounting metrics of GAAP and of IFRS, because those ones give you directionally wrong data, right? For Shopify, you see a startup that's inflecting positively and you get excited. For J&J, you see a stagnant firm that is fully mature and being competed away. For Qualcomm, you see a turnaround that's shrinking to grow when they're actually not. For Fidelity National, you see a good growth company that's trading at market levels that could have opportunities. And for Salesforce, you see a company that has incredibly weak returns. All those, and also has incredibly weak returns, but strong growth. All those insights that you have there are wrong, right? The reality is those insights are directionally wrong.
Valens Research, the world's leading source for uniform financial analytics.